Hey guys, Hector Davil here once again. Today I have a rather important video tutorial lesson for you because we're going to be talking about money management, or more specifically about trading the appropriate lot size on your forex trading, or what's the same, applying the correct lot size into your trades. Okay, this is one of the most important lessons I can possibly give you guys, so you want to watch through this video. Alright, okay, let's get going. Alright, let me first off start with some common money management mistakes, new traders usually make. They believe that stop loss size in pips, let's say, I don't know, a 30 pip stop loss, a 50 pip stop loss, whatever it may be, represent the actual true risk in a trade. That could not be farther from truth. Alright, the stop loss size, whatever it's, regardless of whether it's 30 pips or 100 pips, does not represent the true risk in a trade. Now, another common mistake, trading the longer time frames is riskier because the stop loss is very large. You know, usually when you trade after daily, of the weekly time frame, your stop loss will go up to 100 pips, 200 pips, etc., etc. Well, regardless of how far or how wide your stop loss is, it's not any riskier. All right, and you will learn why in a second. Now, another common mistake new traders make, well, they tend to believe that since they trade a small account, maybe a mini account, okay, or a few $100 account, they should stick to intraday trading because the stop loss are usually smaller, right? Well, again, that actually makes no sense, and in a second you will learn why. Okay, regardless of whether your account is just $100 or $100 trillion, it doesn't matter. Okay, because like I said on the first point, stop loss size does not equal to the true risk in a trade. Okay, now let me drill down into the beef of this tutorial video, and I'm going just to disclose a universal trading principle. Okay, and I mean universal because it's applicable no matter whether you are an intraday trader or a long-term trader, no matter whether you trade forex or you trade stocks or you trade the future markets, it doesn't matter. Okay, like I say, it's totally universal. And it says the trade's stop loss size should determine the trade's lot size. Okay, and not the other way around. Firstly, you calculate the stop loss size and then you calculate the trade's lot size. Again, not the other way around. Therefore, it's the lot size and not the stop loss what represents the risk in a trade. Let me go back into the previous slide of this presentation, and before I said that one of the common money management mistakes new traders make is to believe that the stop loss size in pips represent the true risk in a trade. Again, that's false. It's not the stop loss size, is, as I mentioned right now, it's the lot size what actually represents the true risk in a trade. Okay, again, the lot size and not the stop loss size. Alright, now, I do realize that this whole money management thing may be a little bit confusing. Actually, I agree. So I've tried to sum the whole thing up in just a few lines. Okay, here's the thing. Firstly, you are to determine where your stop loss should be located as per your technical analysis. All right, for example, let's imagine you are trading the typical zigzagging trending price action. Let's imagine you enter long on the market right there and you determine that your stop loss should be located right below the last pullback, okay, meaning right there is where you should locate your stop loss. Well, that's the first thing you have to determine upon spotting a trading opportunity. Firstly, you pinpoint where you want to place your stop loss. Okay, then according to your preferred money management formula, which I will talk in a second, you calculate the appropriate lot size for that stop loss. Okay, so firstly, you locate the stop loss and then you calculate the appropriate lot size for that stop loss. So I repeat again, Firstly, you establish your stop loss right there, and then you determine the appropriate lot size, not the other way around. As I was mentioning on a previous slide, some traders believe that if you have a small trading account, you can only afford to use a, let's say, a 30 pip stop loss maximum. Well, that's totally incorrect. It doesn't matter whether your stop loss is 30 pip or 130 pips, all right? It doesn't matter. Like I say, as per your technical analysis, you place your stop loss wherever you want to place it, okay, or actually wherever it's meant to be placed by your technical analysis, and then we'll figure it out somehow according to our preferred money management formula to calculate the appropriate lot size for that stop loss. All right? All right, a few moments ago I mentioned that you are to apply your favorite money management formula, and well, obviously I cannot possibly review all the different formulas. There are dozens of them. In fact, there are whole books dedicated to this topic. So what I am going to do is to simply talk about my money management formula, okay, the one I personally use. It's actually pretty straightforward. I like to risk a fixed percentage of my account on each individual trade. Again, I risk the same equal percentage, okay, a fixed percentage of the account balance on each individual position. Now, there are a few reasons as of why I like to do that, mainly three. First of all, each trade weighs equally and has the same impact or risk upon the trading account, right? Since I am obviously always trading the same percentage. Okay? Therefore, if your trading system is indeed profitable, statistics will lean towards your side in the long run. This is very important, guys, because trading is all about statistics, okay? Long-term statistics. So, let's imagine your trading system is based on flipping a coin. Every time you flip heads, you make money. Every time you flip tails, you lose money. Well, since that's obviously a 50% win-loss ratio system, and if you are to always risk a fixed percentage of your account every time you flip the coin, well, obviously you will not either lose or make any money in the long term. In the long run, okay, because that's a 50% win-loss ratio system. Now, let's imagine we put some weight on the heads, okay? So we now have a 60% of flipping heads, meaning a 60% of making money, and only a 40% of flipping tails, meaning of losing money. If we are to risk always the same percentage every time we flip a coin, in the long run, we are going to come on top because we now have a 60-40 win-loss ratio, and therefore, again, like I say, in the long run, statistics will lean towards our side, and therefore our account will slowly but steadily grow. And that's the whole point of trading, okay? Consistent gains over the long run. That's why it's important that we always risk a fixed percentage. Alright, it's also important that whatever that fixed percentage may be, you don't make it so high so no individual position makes or breaks the month. Obviously, you don't want to risk a 20% of your account size on one single trade, because imagine you take three losing trades in a row. Okay, that trading account would be completely destroyed for good. My advice is to trade around, or to risk around, a 3% of your account balance on each individual trade. Okay? And finally, and please guys, pay attention here because this is very important. As your account grows, you'll manage to keep always your risk constant. Okay, your risk will remain constant since you are trading a fixed percentage on each individual trade, but your profits will compound on an exponential manner. Let's imagine you start off your trading career with a small trading account. Let's imagine a $1,000 account. All right. But let's also imagine you are kicking tail, you are doing a fantastic job as a trader, and that $1,000 account becomes a $5,000 account within a few months. Okay? Well, every time you take now a trade, your risk will remain constant because you are still only risking a 3% of that account, regardless of whether you are trading $1,000 account, a $5,000 account, or a $1 million account. Your risk always remains constant, but your profits compound. How is that? Because obviously the 3% of $5,000 is much more than the 3% of $1,000. Okay, so every time you will score more and more profits while always keeping your risk under control. Alright, now, since I do know that making these money management calculations can be a little bit problematic, or at least inconvenient, well, I would like to share with you guys the Excel sheet that I personally use when it comes to calculate the appropriate trading lot size for my trades. Alright, obviously, it's totally free. You can find the download link under this video, so go ahead and download it with my compliments. Okay, here's how it works. Up here is where you enter your account's equity balance, for example, $10,000, or euros, or sterling pounds, or whichever currency you've opened your account with. Down here is the percentage that you are willing to allocate to each individual trade. Remember that that's supposed to be a fixed percentage. And down here is where you enter the trade's information. For example, your entry level and your stop loss level. So this Excel sheet can calculate in pips what's the stop loss distance, which is obviously going to be the difference between the entry and the stop loss. All right. Moreover, you are to enter the trade's profit-taking levels. In case you want to use two different profit-taking levels, okay, you want to exit your trade in two sequential levels, well, here you would enter your first target and how much of your trading size you want to exit at that level, and here you would enter your second level and obviously how much you want to exit at that specific level. Okay, so the Excel sheet will calculate, as per this information, your reward out of this trade. Okay, the sheet calculates the risk down here in pips, meaning the difference between your entry and your stop loss, and using this information here, it will calculate the reward. Now, also we have to take into consideration the currency pair pip value. As you probably know, every different currency pair has a different pip value. For example, the euro against the American dollar and also the sterling pound against the American dollar are worth $10 per per standard lot. Each pip movement for one standard lot is worth $10. But that's not the case for every currency pair. That's why if I scroll here on the right, you will find this link where I've placed all the different values, okay, for one pip movement for every single currency pair. Okay, so simply visit that link if you want to access that information. Obviously, it's totally free. Okay, so anyway, once you've punched in this information, the sheet will automatically calculate or automatically tell you how many lots you should enter the trade as per this information here, so the 3% rule is respected. Obviously, if I alter this, for example, instead of 3, I enter 5% and then click on enter, you can see how the lots to trade figure has already changed. Okay, I am to trade 1.67 standard lots according to this trades information. All right, but let me put this back to 3% since that's what I like to trade myself. And there we are, back to one standard lot as per this information here. And anyway, also the sheet will calculate the trade reward risk ratio, and as you can see on this specific trade, I am shooting for 1.5 times more than what I am actually risking. For every dollar I risk, I will make $1.5. Obviously, should my profit taking levels be hit. Okay, and down here, well, we can see the risk data and the reward data. both for the first and the second target. But I don't really want to overstretch this video far too long, so go ahead and download the sheet, with all my compliments. The download link again is under this video, and also here on the right you will find full instructions on how to use it and how to read it. Okay, fantastic and very convenient tool to determine the appropriate lot size on your trades. Alright folks, that's all for this video. I hope you enjoyed it. I'll be talking to you soon. Bye bye. Cheers.